Over the past decade, gold has consistently been regarded as a traditional safe haven asset against inflation, geopolitical instability, and systemic financial risk. However, in the post-pandemic era, global financial markets are entering a new structural phase, characterized by inflation no longer accelerating uncontrollably, yet unlikely to return to ultra-low historical levels. Monetary policy no longer operating under extreme accommodation. Global capital flows increasingly differentiated by interest rate expectations and growth prospects. Within this context, the assumption that gold prices may decline toward the $3,000 per oz level is no longer implausible. Instead, it represents a realistic scenario that investors, financial institutions, and strategic planners must analyze carefully in order to prepare and respond effectively. 2. Macroeconomic drivers behind a decline in gold prices. 1. Monetary policy. Higher for longer interest rates. The most influential factor affecting gold prices remains real interest rates. When nominal interest rates remain elevated and inflation expectations stabilize or decline, real interest rates increase, raising the opportunity cost of holding gold, which generates no yield. Under this scenario, the U.S. Federal Reserve and other major central banks delay interest rate cuts. Markets gradually accept that the era of ultra-cheap money has ended as a result. Government bonds become more attractive. Long-term capital reallocates away from gold. 2. Structurally strong U.S. dollar. Gold is denominated in U.S. dollars, making the inverse relationship between gold prices and the U.S. dollar index, DXY, structurally significant. In a scenario where gold falls toward $3,000, dollar strength is driven not only by interest rate differentials, but also by relatively stronger U.S. economic performance compared to Europe and Japan. Global capital seeking the U.S. dollar as an alternative safe asset. A sustained strong dollar places continuous downward pressure on gold. Weakens gold's rebound rallies. 3. Return of risk-on market sentiment. Another critical factor is a shift in global investor sentiment. When fears of deep recession fail to materialize, equity markets recover. Technology, artificial intelligence, and energy transition assets dominate investor focus. Investors tend to reduce allocations to defensive assets such as gold, increase exposure to risk assets like equities, cryptocurrencies, and private markets. In this environment, gold is not rejected, but it loses priority within diversified portfolios. 4. Relative de-escalation of geopolitical risks. Gold typically rallies when conflicts escalate dramatically. The global financial system faces existential threats. The $3,000 gold scenario assumes that major geopolitical conflicts do not materially expand. Risks become priced in by financial markets. This does not imply global peace, but rather that markets adapt to persistent uncertainty. 3. Price dynamics. From peak correction to the $3,000 level. 1. Breakdown of key technical support levels. Major gold corrections rarely occur quietly. A plausible sequence includes repeated failures at major resistance levels. Breakdown of key technical supports, cascading stop-loss orders accelerating the decline once psychological support levels are breached. Downward momentum typically intensifies. 2. Short-term capitulation phase as prices approach $3,000. Panic selling emerges among late-stage buyers. Financial media increasingly uses terms such as collapse or end of the gold cycle. Historically, this phase often marks the final stage of a correction, though it inflicts the greatest psychological damage. $3,000. A psychological level, not a guaranteed bottom. The $3,000 level represents a major round number threshold, a zone where long-term capital begins careful observation. However, prices may experience a technical rebound, or enter prolonged consolidation, or even break lower if macro conditions deteriorate further. 4. Broader market impacts. 1. Global financial markets. Bonds benefit from sustained high real yields. The U.S. dollar maintains structural strength. Equity markets advance, albeit with increased sectoral divergence. Gold does not trigger systemic stress. It simply cedes its defensive leadership role. 2. Physical gold markets in Vietnam. In the Vietnamese context, domestic gold prices decline more slowly than international prices. The price gap between local and global markets tends to widen consequently. Short-term traders face increased difficulty. Long-term accumulators remain patient, awaiting favorable valuations. 3. Investor psychology and media narratives. Retail investors become increasingly anxious. Headlines declaring gold is dead proliferate. Such narratives typically lag price action, rather than lead it. Strategic responses by investor type 1. Short-term traders avoid blind bottom fishing. Trade only with confirmed reversal signals. Enforce strict risk management. 2. Medium to long-term investors accumulate gradually through phased allocations. Focus on preserving long-term purchasing power. Treat gold as a portfolio stabilizer, not a speculative growth asset. 3. Investors holding gold at higher prices avoid panic selling during market stress. Reassess original investment objectives. Accept that gold, like all assets, moves in cycles. 6. Long-term implications of the $3,000 gold scenario. The key takeaway is a decline in gold prices to $3,000 does not signify the loss of gold's historical role. Rather, it reflects a market recalibrating to a new equilibrium. Over the long term, global debt levels remain elevated. Systemic financial risks have not disappeared. Gold retains strategic relevance, however. Gold does not rise continuously. It is not always the optimal hedge in every macro regime. 7. Conclusion. The scenario of gold declining to $3,000 represents a stress test of investor conviction, a cleansing phase for market psychology, and opportunity for disciplined, patient capital. In investing, the greatest risk is not price volatility, but failing to understand why an asset is held in the first place.